Welcome to everybody watching this as part of Trentham Invest. We bring you some news for 2021. And the news that we're bringing you really is about our thinking and strategy for the portfolios and for investing for this coming year. And I first of all want to start off by looking at last year for 2020, what were some of the key things that happened, where's the focus, where are people's minds, and how we can really zero in on taking best opportunities for 2021. So key stories from last year, there was a strong bounce back, as we know, from the global markets at the second half of the year. It really started in April, so a bit earlier than just half of the year. The short-term focus is very much on virus-based, and even today, as I sit here talking, we are in the middle of another lockdown. The medium-term focus, however, is on the vaccine and the rollout of that. And there was a pickup, as I say, in the market from sort of April last year, very much led by technology companies, the value of those companies, those industries that are able to pivot and embrace technology have been the ones that have really driven the value of the globe. The UK has lagged in that area, and there's a very small percentage of the FTSE All share that's linked to technology. What else have we got in 2020? Further fiscal action from the government, a huge input from that, and because of that government policy, that was really a shot in the arm before the vaccine, but from the government. Brexit trade deal, that was agreed for January 21. Consumers really have saved a lot more last year, and the savings rate, or the rate of savings, has gone up. And that amount of cash that's sitting in the system is just really ready for spending, and there's a lot of spending power. There's been no austerity last year. And look at the US stocks and the UK stocks. The US looks very expensive, probably to do with Tesla, Google, Facebook, and the likes. And the UK stocks, however, look really cheap and a good opportunity. Dividends generally were cut by, significant sums between 30 and 40%. Companies, ceased dividend payments, so there was a lot of, impact from there. So those are the key stories really for 20. Looking at property funds, again, we've spoken a lot about property last year. In our portfolios, 3 funds were suspended. 2 of them came off. Those 2 were Legal & General and BMO. And we still have 1 remaining, which is Janus Henderson. We're hoping that's going to be coming off soon. But there's a lot of talk around property, and our view is that over the long and medium term, they do provide a positive return. Every investment has its moments, whether they're positive or negative. It's just part of being invested and part of life. So property isn't something to be dropped like a hat. The yield on property, or the return, is certainly higher than cash and bonds. I think there was a phrase, don't throw the baby out with the bathwater. I think there's going to be a lot of change, and there could be a lot of change from commercial property to residential property. So how are fund managers going to make sure that a fund remains in their portfolio as a commercial property fund manager when that building converts to residential? Well, they may be looking at management companies, and certainly the younger generation of today what they're looking for is a whole package deal. They want a bundled system where within the rent is included gas, electricity, Wi-Fi. They don't want separate relationships with those suppliers. They want a bundled package. So if that's the case, they'll go with a management company, and that will be a solution for the commercial property manager. So if we look at some of the facts on the table, we're looking at volatility, we're looking at returns, and here are some figures. And as I've said many a time before, and people say it's different this time, it really isn't. The figures haven't really changed from a 10-year horizon. The biggest change really is in cash. So let's take an insight into those. We're looking at the expected return on cash, 0.43. These are September figures from September 20. The volatility, the up and down movement at 1.1%. Bank of England base rate today in January 21 is 0.1%. And I would see that expected yield figure of 0.43 from September to reduce when the January figures are published. Expected yield on fixed interest is at 0.73 with a volatility of 8.27. International bonds, expected yield 1.09. That varies from 1.84 6 months ago. Volatility at 9.28, whereas it was 9.32. Appreciate there's a lot of figures and data here, but this will come in writing also. So really not much change. Commercial property expected returns a bit lower than 4.04. We're down to 3.82. Volatility remains 8.8. UK equity expected return at 5.6, whereas it was at 5.8, so a slight drop there. Volatility remains at 8.6, 8.7. So clients, what do we have? Two really major things on clients' agenda. Either they're in drawdown, you're in retirement, and your primary focus is to preserve your wealth, preserve the capital, to deliver a constant income for your future and the rest of your life. Or the other one is those thinking about investments from cash reserves going into investments and building up your resources for the future, and you want really the best return on your capital, perhaps going to take a bit more risk and prepared to take more of an up and down ride on that journey. If we look at our scale of 1 to 10, and we use a traffic light system where you can really zero in on the behavior and the risk of your portfolios, whether you're on 1 or 3 or 5 or 10, but majority fall into anywhere between 3 and 5 on that scale, where 1 is low and 10 is high. We take our figures from actuaries, Willis Towers Watson, and just interestingly, looking at a risk-3 portfolio. We did this in July, and what they said was put 53% in cash. Well, this time round, they're saying 60% in cash, and that just really isn't going to work. With a pension pot, with an investment pot of 60%, with an investment return of 0.01 on cash, the fees and the charges of the platforms are just going to eat that alive. So we're very aware of that, and there's also a paper coming out from the FCA, the authorities, to say, really watch out putting your money on a platform where there's this much amount been recommended in cash. So we're going to amend these portfolios, we're going to amend the asset allocation so that you're not drained on fees. Looking ahead, the challenges that we have and what we want to deliver for clients here at Trentham Invest is that your portfolios do perform, that they perform ahead of fees, charges, and inflation, so that you are winning with your hard-earned wealth. The winning strategy is one where it has to be adapted from 60% in a risk-free portfolio and 60% in cash. That must be modified and adapted. So we'll be doing that. We'll be writing to you with the interpretation of that and the solutions, and then tailoring your portfolios accordingly. So best wishes to you all, and I look forward to seeing you on the next update.